Hi, it's Leo. Let me ask you something. Have you ever had $100 sitting in your pocket or maybe in your bank account and wondered how you could turn it into $1,000, $10,000, or maybe even $100,000? Because here's something strange. Most of us spend years in school learning things like math, history, science, but almost nobody ever teaches us the one skill that actually affects our entire life: how money works, and more importantly, how money grows. Because of this, investing can feel confusing, sometimes even a little scary. People hear words like stocks, ETFs, real estate, crypto, and immediately assume they need thousands of dollars to get started. But the truth is, many successful investors started with very small amounts of money, sometimes even less than $100. So in this video, I'm going to show you 7 different ways you could invest $100. We'll start with the safest options first, and as we go through the video, the risk will slowly increase. But remember this, as the risk goes up, the potential reward usually goes up as well. And by the end of this video, you'll understand exactly where beginners should start. All right, let's begin with the safest option. First is a high-interest savings account, risk level 1 out of 10. Now, I know what you're thinking. A savings account is boring. You're not going to become rich overnight. And that's true. But there is a very important reason why this comes first. Before anyone starts investing, they should build something called an emergency fund. An emergency fund is money set aside for unexpected situations. Maybe your car suddenly needs repairs. Maybe your laptop stops working. Or maybe an unexpected bill shows up. If you don't have savings in these situations, most people end up using credit cards or loans, and that's usually where financial problems begin. So while a savings account might not grow your wealth quickly, it creates something just as important: financial stability. Once you have that safety net, then you can start looking at investments that actually grow your money. The second investment is gold, risk level 2 out of 10. Gold has been used to store wealth for thousands of years. Long before paper money existed, gold was one of the most trusted forms of currency. And even today, many investors still see it as a safe haven. Why? Because unlike money, gold cannot simply be printed. Governments can create more money whenever they want, but gold has to be mined from the ground, and that scarcity is what gives it value. Historically, gold tends to perform well during times of economic uncertainty. When markets become unstable, many investors move their money into gold. But there is one downside. Gold usually doesn't grow as fast as other investments like stocks. So while it can help protect your money, it may not grow it as quickly. That's why many investors use gold mainly to preserve wealth. Next, we have index funds, risk level 3 out of 10. This is where investing really starts to become interesting. An index fund is basically a collection of companies combined into one investment. Instead of trying to guess which single company will succeed, you invest in many companies at the same time. For example, the S&P 500 index includes hundreds of some of the largest companies in the world, companies like Apple, Microsoft, Amazon, Google, and many others. When those companies grow, the value of the index fund grows as well. This is why index funds are often recommended for beginners. They're simple, they're diversified, and historically, the stock market has returned around 7 to 10% per year over long periods of time. Now, this is where something powerful happens: compound growth. If someone invests small amounts consistently over many years, that money can grow into something surprisingly large. And that's one of the reasons index funds are so popular. The fourth investment is something called a REIT. Risk level 4 out of 10. REIT stands for Real Estate Investment Trust. When most people think about real estate investing, they imagine buying a house or an apartment, but that usually requires a lot of money. A REIT works differently. A REIT is a company that owns income-producing properties, things like apartment buildings, office towers, shopping centers, and hotels. Investors can buy shares in the REIT and receive a portion of the rental income. So instead of owning an entire property, you own a small piece of many properties. The interesting part is this. Most REITs are required to distribute a large portion of their profits to investors, which means they often pay regular dividends. So with a relatively small investment, you can start earning income from real estate without being a landlord, without fixing broken pipes, and without dealing with tenants. The fifth option is buying and reselling items. Risk level 5 out of 10. This method is less about investing in markets and more about using knowledge and opportunity. The idea is simple. Buy something cheap, then sell it for more. People do this every day on platforms like Facebook Marketplace, eBay, and other buy and sell apps. For example, someone might sell an item quickly for $40 because they want to get rid of it, but the actual value of that item might be closer to $80 or even $100. If you understand what things are worth, you can buy low and sell higher. Many successful entrepreneurs actually started this way, turning small amounts of money into larger amounts through simple trading. Next, we have individual stocks. Risk level 7 out of 10. Up until now, we have talked about investments that spread your money across many assets. But when you invest in one specific stock, you're investing in one specific company, and that increases both the potential reward and the risk. If the company performs extremely well, your investment could grow significantly. But if the company struggles, your investment could lose value. This is why stock investing usually requires more research. Investors often look at the company's financial performance, its leadership, and its growth potential. Stock investing can be exciting, but it also requires patience and learning. The final investment is cryptocurrency. Risk level 9 out of 10. Cryptocurrency is one of the most volatile investments in the world. Assets like Bitcoin and Ethereum have produced incredible returns in the past. Some early investors saw their money multiply many times over, but cryptocurrency can also fall very quickly. Prices can rise fast, and they can crash just as fast, which means there is a significant level of risk involved. Because of this, many investors treat cryptocurrency as a small part of their overall investments, not the entire strategy. So, if you had $100 today, which option would you choose? The truth is, the exact investment matters less than one very important habit: consistency. Investing once is good, but investing regularly, month after month, year after year, is what actually builds wealth. Small investments, made consistently, can grow into something much bigger over time. If you enjoyed this video and want to learn more about investing, side hustles, and building wealth, make sure you subscribe to the channel.
I'm Leo, your wealth guide. See you in the next video.